absolutely. We are going to switch gears here for this panel, where we are going to be discussing capital raising for the critical mineral supply chain, or what is now called mining tech in Silicon Valley. Excited to have our panelists here with us today. They not only have deep experience in tech and mining tech investment, but they represent different perspectives from the investment landscape. And so this should lead to a very lively discussion. What I'll do here is just quickly introduce the panels. And we have some prepared questions which we will start with. But importantly, I want to encourage the audience to please ask questions. So I think that gets submitted by Slido, or you know what, just raise your hands. We're amongst friends here, so no need to be bashful. So to introduce our panelists here, Mark Frayman on the left is a managing partner of Orion Industrial Ventures, a venture capital platform focused on technologies in critical minerals. OIV is part of the Orion Resource Group, an $8 billion private market fund with strategies dedicated to metals, mining, and industrial operations. Prior to joining Orion in 2023, Mark founded BHP Ventures, the CVC of BHP, and closer to home, Mark led the investment for BHP in KoBold in 2021. Rahul Meka is a senior associate at venture capital firm Playground Global, where he's active in deep tech investing across decarbonization, automation, and AI. He has experience at Magna International and Intrinsic, which is a Google X company, has worked across electrification, autonomous mobility, robotics, and computational imaging. Mining does run in his blood. He comes from a family of geologists and spent some quality time around some mines in his early days. We have Kunal Sinha from Glencore. Kunal is an SVP of marketing at Glencore and oversees Glencore's global metals, recycling, and circularity businesses, as well as business development for copper, cobalt, lithium projects in North America, and all of its investments in North America as well. So I welcome you, Kunal. And then finally, on the right side, we have Rajesh Swaminathan, who is a partner at Khosla Ventures and has 2 decades of experience investing in deep tech startups. He manages many of Khosla Ventures' investments across climate tech, industrial, decarbonization, and advanced manufacturing. He is also the returning champion to this panel, having served on the panel last year. So we are going to start with a question directed at Rajesh, and others will absolutely jump in and share their perspectives as well. Rajesh, investing in the critical mineral supply chain, or mining tech, as it's called, means you have many alternatives across the spectrum, from exploration to midstream processing, all the way to downstream. Give us your perspectives on how you look at investing along the supply chain and what your experiences have been.
Yeah, just to give you a perspective, we have a $16 billion assets under management. We have a separate seed fund, a main fund, and later stage fund. And we've been investing across all those funds in the mining sector. So there is certainly a lot of capital that's been coming into the sector, and a lot more is needed for sure. I look at it as 3 different things. One is, you could be investing in hardcore, hard tech sectors where there is not a lot of software play, and we have done 1 investment there. Then there are companies that have an interesting hard tech, but a lot of software integration as well. That's another segment of mining companies. Then there are pure AI companies that will be getting a lot more capital now and in the future as well. So for instance, instead of living in generalities, I'll talk about 3 examples we have done in each one of those verticals. They're a completely different problem in terms of how do you raise money, what's the business model, all of that stuff. We invested in a company called SIBO, which is going after taking an electrochemistry approach to copper, leaching copper to extract copper from sulfides. They can go down the time from 1,000 days to 200 days, 1/10 the capex, all of that stuff. They're working with top 7 out of the 10 mining companies. So that's a pure kind of a hardware play in a big way. Different business models being worked out there. You could own the asset, you could partner with some of the strategics to extract the most value. So you're not just creating value, but capturing the value as well. The second example is a company called Mariana Minerals. It's been stealth for some time, but it's the interesting approach of fully vertically integrated operating system for mining, for factories as well as capital. This is a great team from Tesla that has come in to disrupt the industry. So that's a different approach to how do you attract capital. There, some good investors have come in, including Andreessen, Breakthrough, ourselves. The last segment of mining, just to set the stage on where the investments could go, is a company called Terra AI. John Munn is here somewhere. That's purely taking AI to look at sensor fusion from geochemical, geophysical, as well as drill data to accelerate the overall campaign strategy. Again, these are completely different approaches. Your answers are very different for each one of them. The most common thing I would say is, if it's a startup, you're coming in to disrupt the whole world, it's not interesting to be just a services company. But it's not necessary that you have to go own the entire asset to be able to extract value. You should figure out what you're really good at and figure out a way to capture value, not just create value.
Any other perspectives from the panelists here?
I'm happy to go next. So I work for a firm called Playground Global. We're an early stage deep tech firm. We only focus on seed and Series A companies. And our perspective is to invest in deeply technical founders that are using some scientific breakthrough to unlock something unique in the physical world or in a legacy industry. So in that case, we've got one company, Gary Agnew, who's the CEO of Ideon. And that's a little bit of a poster child of how we think about mining. Just like any other legacy industry, you need some unique data set or some unique insight, which we believe like muon tomography is the ideal sensing modality to give you that unique data set. And once you have that unique data set, that becomes your wedge in to create value for your customers. In this case, it's existing or big mining players and new mining players too. And we think about using that data set and leveraging new tools like AI in order to be able to provide insights that weren't possible for like mining companies. And if you think about a company like that, it's almost trying to change the way existing mining companies or existing legacy companies think about curating information and thinking about the world because they're not used to that new class of information. And so when you think about fundraising for a company like that, we're obviously underwriting the technology in the early stages, but as you go along, you see the traction that they're creating with the different mining majors and the ability to land and expand. And beyond that, the company in this case is also thinking about how you can go beyond just exploration and into like mining operations, which is where there's a lot of value, like Rajesh talked about.
So let me tilt it towards a little bit of a different question here. Rahul, you spent time in the mining sector or around mines early days, but your background is not in mining. The title of this panel suggests that there is a pool of capital for the mining space or the mineral supply chain that is waiting to be unlocked. What's your all's perspective on capital formation in the sector? Is there more capital coming into mining tech or related investments? And if so, what are the business attributes or business models that will really unlock that capital?
Yeah, I mean, deep tech is really hot and new now, but there's some funds and firms that have been doing this for a while. And when you think about the different frontiers of industries that are still left to be disrupted, mining is obviously one of those foundational industries that's pretty critical, no pun intended, to unlock the critical metals for either the transition in the future or like building the computation that we require for AI and so on. And so there is a lot of interest in thinking about actually being completely vertically integrated in how you disrupt this ecosystem. And so mining's an obvious choice and one of those, at least frontiers that we felt like that needed to be disrupted when we made the investment anyway. To answer your question about my background, I think ultimately I have a background in computational imaging. So when you think about how do you get unique sensing data insights, it's translatable, right? Between robotics or autonomous vehicles, it's ultimately being able to parse information that's unique and give a unique insight. And so that's how we sort of like triage such opportunities. And to answer your question about capital formation for mining companies, look, I think venture capital startups, and Rajesh can probably talk about this, they all plan for like a 2-year runway. This is like a known thing, right? But when you think about landing a customer, such as a mining major, it could take anywhere between 6, 8, 12 months to do a pilot, right? it's pretty important for the existing customers to obviously buy into the technology, and we look for traction and signal in terms of those pilots converting into commercial opportunities, not with just innovation teams, but with like operation teams. And that's a pretty good signal in terms of how you think about the company having business progress or technical progress. And in terms of other capital, I think, you know, startups like live and die based on venture capital equity to start with, but need other forms of capital. And we think that a signal from the mining majors who have a ton of cash to actually provide working capital to build the sensors, for example, could be a pretty interesting way where you're not using cost of equity to buy the sensors and hardware. You're using that to actually develop the technology and build a team.
Mark, you've spent time at a CVC at BHP. You're part of a platform that is has a parent company that is dedicated to the mining and industrialization sector. Offer some perspectives there, please.
Yeah, I agree with a lot of what Rahul just said. I don't know if mining, though, I don't think the pool of capital is going to be unlocked because of the opportunity to disrupt mining. I don't know if the sector needs disrupting. I think as it actually is evolving quite rapidly. I think if you look at where major miners are, BHP, Rio to name a few, but others, and Mark could have only spoke about it from a Vale perspective, like, you know, they are embracing new forms of technology quite rapidly. But to answer your question, and maybe I'll offer a perspective outside of just venture, because across Orion, we have strategies that range from, we don't do exploration finance, but we do mine construction and completion finance. We have a discretionary hedge fund trading strategy, a trade finance strategy. Across the pool, we are seeing capital come towards this sector. We're seeing it, one, yes, there is a huge opportunity to apply technology to evolve the sector, but I think it's just become front of mind to many generalist investors that are now approaching firms like us saying, hey, these big factor trends in the economy, you know, decarbonisation, urbanisation, digitalisation, now militarisation, each of them needs critical minerals. I think people are seeing mining as a sort of a factor exposure to many of those sectors. I think second, we're seeing, and this has been a real change in the last 12 to 18 months, the arrival of public capital to complement private capital. We're seeing that in technology grants and non-dilutive funding. We're seeing it in, I mean, just in the US here, the sort of alphabet supers, government agencies, the DOE approaches Orion about certain commodities, the DOD about others, State Department about others. We're seeing capital, we announced a $1.2 billion joint venture out of Abu Dhabi to invest in regional mining plays. So we're seeing the arrival of public capital, which I think's then sort of reinforcing more private capital. So I think the capital is being unlocked as we speak.
Kunal?
Mark is a good friend, so I can disagree with him for the heck of it, just to make it interesting. So I don't think any of the big companies will ever innovate in a disruptive way, and this is nothing specific to the mining industry. Big companies have a role, but this is nothing unique to the mining industry. Look at Tesla, it didn't come from GM or Ford. Look at SpaceX, it didn't come from somebody from Lockheed. Look at Airbnb, it didn't come from somebody in the hotel industry. Look at every industry, like Square or Stripe, it didn't come from another credit card company. Like, these are entrepreneurs that are coming from a completely different sector and want to disrupt a sector. The BHP, Rio Tintos of the world have a huge play to help scale up some of these companies, but the core innovation is not coming from these big companies, which is where the startups, disagreed for the heck of it.
No, I agree with you. I think that core innovation is...
Which is why you have the venture group, which is why you're driving it, which is why the CVC arms are very critical.
Correct. One thing I would say, though, when we look at a startup, and we spend a lot of time on this, we use our networks, and I'm saying we from an Orion perspective, but from BHP we could look in-house to understand what the majors are doing in-house. I think one thing that, you know, generalist investors sometimes in this sector make the mistake of is saying, hey, here's a cool startup coming out of X university without understanding that the same problem, and take SIBO, which we're both investors in, you know, chalcopyrite leaching has been trying to be solved by majors for 30 years. So we invested in the company because we believe the innovation will come from the outside, but be remiss to not think that there is innovation happening on the inside as well.
And SIBO is a good example. We invested 6-8 years ago, and you guys have come in the last few years, which is great. But the timing matters in terms of, this is where the startups have to go and make that innovation happen, and then, you know, partner with the CVCs, the bigger companies at a later stage to help scale up.
Kunal, let me bring you into this discussion here.
Sure. So I'm just going to offer some random thoughts on everything that was said. So, and they're all, at least I know two of these guys. So I think there's the core question is, like, look, it was established yesterday. I mean, Mark and David said mining is ripe for disruption, and yeah, I agree. And I think the question is, how do you disrupt it? And there are two valid ways of disrupting an industry, in my opinion. You can either say, I will replace this industry because it's sleepy, old, moves slow, and I'll just come in and replace it, which is a valid way, and I think people should try and do it. I would encourage it. The other way to do it is to say, all of that is true about this industry. I'm still going to disrupt it, but I'm going to work with you and make you cheaper, faster, leaner, smarter. They're both valid ways. I'm not picking sides, and I've worked with startups, and I've looked at startups that are trying to do both. It's hard for me to say which one is going to actually disrupt. It is clear one or the other or both models will end up disrupting. In terms of capital, I think it's actually quite funny because it looks like suddenly critical minerals has had a lot of interest in like last 6-12 months, but it's not new. I mean, it's without critical minerals, we wouldn't even be here. Actually, I kind of disagree with the term critical minerals because if everything's critical, nothing's critical. Like suddenly, like everything's become a critical mineral. For me, copper is the one that exemplifies the issue, and we won't go into it because we already discussed it yesterday. But from capital, the observation I've had is there's been a wave of investments in the space. We invested in some went well, some haven't done well. I think the learning is the new wave of investment from whether if I look at Glencore's perspective, we are always looking at things we can invest in, but also like other investors, both from a VC perspective or growth equity, like they would like to know our views, and so we talk. So I think what's different this time is there seems to be a heightened focus on, so what is the actual business model beyond the tech? And is it actually going to make money? And, I didn't realize last time around that hard tech will require billions of dollars to actually scale. So how are you going to scale that? Because at some point, I think business models have to match sort of, how should I put it, like the patience level of the capital. So I think, Rahul said, and others will agree, like venture only goes so far, and there's certain timelines. And some of these hard tech businesses will not have SaaS-style returns, both in terms of the timeline and when you hit the inflection point. So how do you match? You have to have venture to get it started, but you need to bring in other forms of more patient capital to actually build these plants to get to the product. So I think that's another. So the capital is there, to answer your question, but that capital is asking these questions in this latest round of investments, at least the ones I've dealt with. Very early stage, of course, is a very different way to look at it. And then the last thing I mentioned is I think it's different based on critical minerals, a very wide space. There are different challenges as you go from exploration, extraction to midstream processing to the downstream. My view is the downstream, at least here out west in North America, we had a lot of money flow in the downstream under the last administration. A lot of capacity got built or was approved, a lot of money, government money went in. We didn't really address upstream and midstream. The difference now I see in DC is there's a huge focus on midstream. And yeah, I know it's difficult with changing priorities and whatnot, but we are close to closing on a substantial amount of funding on a midstream. And I can tell you, there's a lot of support as long as you can show that it's actually going to make money and you can pay taxpayer dollars back. So again, it's like matching early capital with late capital and bringing in, government funding. So if you can do that, it's actually, right now is a great time to be figuring out how to put together a deal on the midstream, including scaling up some new technologies.
Let me pull on a thread that you just introduced there, and that is the changing environment that we've been seeing over the last year for investing potentially in the critical mineral supply chain. That is geopolitics, trade, new administration here in the US, commodity price volatility, the advancement of AI, recognizing that you're all, of course, long-term investors. But is there anything over the last year, or call it a year to 3 years, that has caused you to evolve your thinking in any way about how you look at businesses or business models or parts of the value chain that you find most interesting or a little bit apprehensive about?
Maybe I'll just continue from what I was saying. I think one thing that we have noticed is I think it's really hard to build a business plan assuming a certain structure in the market that's not driven by free markets. And I think a lot of that happened in the last wave, which is I have a very cool technology, it extracts something, but when you run the economics, it doesn't make sense. And the response would be, well, I'm going to get a green premium, or I'm going to get a Western premium, or I have the 45X, or I have. So a lot of that was there. And I think even through the cycles, the folks we work with, we advise that it's good to have that, but that can't be your baseline model, at least from our perspective. And we are arguably not a very classic sort of venture, or we are a big mining company, commodity trading company. So we had always emphasized that it's good to count all the credits and subsidies, and you can throw a green premium on top or a Western premium, all the premiums. But that's all a scenario that's on the upside. Your base case still has to make sense on the hard economics of how the world really operates. I think that's a big change now, which is you can no longer, I don't think you can finance a business. And no matter how much people want to argue about it and say that the administration is not supportive and whatnot, it doesn't make sense. So there's a big issue right now with 45X, and a lot of people are talking about it. And my view is, if your business was never going to be profitable under 45X, like how can you guarantee 45X would have been there for 40 years? So I think that's a big shift, and I think that would weed out weaker business models. In the long run, the only businesses and models that will work, whether it's AI-driven or hard tech, they have to make money in the long run.
Yeah, just to add to that, I think two different takes with two different kind of flavors of companies. One of them, I think you have to go after something that's got the least friction in terms of deployment. And so if you're trying to go after like completely greenfield opportunities where capital might be like more, hard to come by, and the risk-reward ratio is like a different calculus at this point, then going to a brownfield facility, improving the profitability of existing operations, extending the mine life, for example, is a pretty good way to obviously get more traction. The other end of that sort of spectrum is, of course, it's a global world, and there are opportunities created in other parts of the world just because of like geopolitical sort of decisions. And example of that is you have a country like Australia where you have every known sort of useful critical element there. But all they've done is dig it up and send it for processing to a different country. What if they become the processor, right? And if you use electrochemistry, which is, again, something that's only become novel because of green hydrogen, just novel membrane technology, whatever you want to think about it, cheaper renewables, cheaper price of electricity, then those things become viable options as well. And so, you go to different geographies, you have different processes that unlock those geographies, or you go to existing brownfield facilities and actually create profitability for them.
I'll just add to that, I think it really enhances the appeal to us as a technology investor. Once upon a time, you saw a technology it could apply in the US or in Australia, but just look at this event. I mean, we've had people from multiple African countries. We've had people, we're probably underrepresented here, there, you at times, but definitely in America, South America, we're investors in companies out of Chile. So we're seeing companies emerge from different parts of the world. We're also seeing the market for these companies grow globally. You can actually have a very, very large, very profitable technology company investment that grows globally that you probably couldn't have had 5 years ago.
Yeah, if I may add to that, there are some real trends why mining sector needs to be hot and will attract a lot of capital. But there are some artificial trends where there is it's hot, it's hype, therefore money will come in, and just as fast as money comes in, it goes out fast as well. Like we've been investing in clean tech for 20 years. I've been personally doing it for 17 years. There was a period of 8 to 10 years where you wouldn't touch anything that's hard tech. Like mining is even longer than that, than solar or wind in terms of like return of capital and so on. So if I look at the sectors we have invested in, things like fusion or using YBCO or Repco tapes, there is a strong interest in discovering materials that will provide much higher current density, lower cost. If you look at things that we have invested in motor, rare earth materials is critical. If you look at batteries, that's a real trend, right? Going from LFP to other materials is a huge trend. So, and copper, of course, we have all talked about it, right? So there's a bunch of industry that really require new materials, even AI-based materials discovery that we have invested in. So there is a lot more to be unraveled. What I do worry about is investors jumping into a sector just because somebody tweeted yesterday saying they're going to go and attach Canada or Ukraine or Greenland, all of that stuff, like reacting to it and throwing money at it is not the right way. It'll drive up the valuation, not the value of these companies. So you have to be skeptical about those trends, but really capitalize on how we want to actually build these companies to value. That part is very critical.
What are you seeing in terms of your LPs and interests? I know that you are all long-minded and interested and have been for some period of time in the sector, maybe newer entrants among this panel. What are you telling your LPs, or what are they saying? Where's the capital coming from ultimately?
Yeah, I'm telling my LPs we are climate investor, but we are drill, baby, drill. We're drilling for geothermal, we're drilling for geological hydrogen, we're drilling for critical minerals, right? So you have to appeal to what the industry can do. An existing industry can be disrupted and you can make money, but you have to connect the dots in terms of you should not pick AI for the sake of it, but how is AI solving a specific problem and how is it really going to accelerate versus sugarcoating it with AI or sugarcoating with software solution that going to move things faster. And government support is also critical. So trying to build that coalition of big companies, we've co-invested with BHP and other mining companies as well. So having that coalition and communicating to LPs that there is a returns potential, history helps, but also clear action in terms of how we are de-risking helps a lot.
Just some questions from the audience here. You all have met with or been pitched by many different types of startups, or you've gotten to know companies over a period of time. In the companies telling their stories, what's actually resonated in the way they talk about the businesses as opposed to the actual business models themselves? And that would really represent the emphases that they see on their business operations or where their skill sets reside. But what's resonated with you?
For me, is it an aspirin or a vitamin, right? Like if you're presenting a solution, are you solving a huge problem that the customer will get out in the middle of the night and go and get a medicine? Or it's a vitamin, like you can live with it, you're adding an incremental solution. So the quality of the problem and how you're solving it is the most critical one. And then what is your approach to monetizing it the right way? And that can change. Like we don't make an investment decision based on your business model today versus what can be later, as far as you have not given it away.
Yeah, I'd add to what Rajesh said. I think we see a lot of technologies that are really, really cool, but they're not actually doing much for the end customer, or they're not innovating much compared to what's done in-house. And being able to articulate that and why someone would pay for that is really important.
Maybe just adding on, again, slightly different lens, not standard sort of VC structure here, but three things. We look at, add on Mark's point, so are you really solving a problem someone wants solved? And a great quote from yesterday, David said, like, we're still doing concentration using a technology invented in 1919, so why hasn't someone disrupted that? Like, I think if you do that, want to work with mining companies, I don't see why mining companies won't invest or give you the contract. But it looks like a lot of people are not really solving the problems this space actually faces. It's like, I invented something cool and I want to apply it. So I think not everybody, but so there's that fit. The other thing is, at least from my perspective, you have to be able to convince, even at that early stage, you know how to scale it and you know how to run it at scale. And the last thing I say, because most probably because I'm a bit jaded with stuff I've seen, is a lot of people understand how to make money because you can write this model and show it's much easier to lose all that money. So have you thought about the risk of when you're not a startup and you are this billion-dollar company and you're going to run it? Have you designed your core business or actually the tech that it protects you from certain very basic risks of this business, the commodities business? Not about, I don't know much about tech or other stuff, but this is a very specific business with metal prices and commodity risk. So we look at those things, and where it resonates, I think that's a great place to work together.
Yeah, just to add to that, I think one unique perspective we have is we really care about that unobtainium sort of technology. So we don't want to be sort of in a business where there are multiple players potentially, and the fight to who wins that ultimate battle is basically anyone who gets access to the right person, who's at the helm of certain company, who's decided to give you access to certain unique data that gives you a unique insight. So if it's don't worry, this is AI magic sauce that's just gonna like work. I mean, sure, it could work. It's just that's the kind of risk that we don't take. We also, again, don't underwrite businesses with the expectation that any subsidies or policy is going to like land the test of time. And so those two are pretty important on top of everything that these guys just talked about.
Another question for the audience, a bit of a different perspective here. We work in a extractive industry. It's obviously focused on sustainability, environmental impacts, and ethics. How do you evaluate companies? Let's focus on ethical standards and what the real priorities are as you evaluate companies.
I can go first. It's one of the big levers that we care about is not having to trade economics for sustainability. So you should be able to use a sustainable process to get economics. And an example of that is electrochemistry, like we just talked about, or using unique muon tomography that does not require you to extract as much material. And so there's a direct sort of correlation with the technical approach and sustainable outcomes. Ethics, I think you are serving customers that you hope are following those practices, and you're sort of subservient to that in a lot of ways. And these companies have been around for tens, hundreds of years, and yeah, you're obviously following suit.
Mark, you've been in the sector for a long period of time. Is there any how do you as a more experienced mining investor look at sustainability or ethics?
I mean, I agree with what Rahul said. I think if you're trying to trade off a sustainable green outcome for an economic outcome, in the long run, your business is going to struggle. I think the two need to go hand in hand, and efficiency drives better sustainability. I think, we're increasingly spending more time on our investments looking not just at the sustainable impact the technology can cause, but also how the team is structured. Teams are growing quickly. Do they have sustainability policies? Do they have ethical sourcing? What does the startup's own supply chain look like? So spending more and more time thinking about that.
I'm going to take a page from the book of Kurt House, who's not here, but on predictions. If we were to be all gathered here again in 2 years' time, let's give it a little bit of a runway, or 3, or you guys can define exactly what the time period may be, but don't make it too long. What will we be talking about in, let's say, 2 years? What will be the companies maybe that are, or business models that are getting the most spotlight, or some of the items that we're all going to be focused on?
Yeah, 2 years down the line, I think we'll be talking about a company or two that would have accelerated discovery much, much faster. Take a couple of years instead of 8, 10 years, and that would have increased or changed the false positivity, false negativity significantly because you're using AI the right way, but also bringing kind of machine learning, AI into the mining operations as well. I mean, this is an old industry that absolutely needs to get disrupted, and there are companies working on it, and we'll be talking about them.
I agree. I think we'll see a lot more startups to where you began today, Chuck, talking about mining tech, not just exploration tech. I think discovery is the first thing. We need more supply coming on the top of the funnel. But I think we're going to see other elements of the mining value chain, that are big buckets of capital or OPEX for a mining company, like maintenance, or other areas that are probably not thought about by a lot of young entrepreneurs, people coming from outside the sector, doing their homework and really understanding what a mine site looks like and saying, well, where's the opportunity for tech in a mining operation day to day? I think we'll see a much deeper breadth of startup flow in that area.
I'm really hoping in 2 years from now we talk about the mining sector not being a single-digit margin business, all enabled by tech. And that I think happens at all parts of the supply chain.
Maybe I'll take a slightly different view. I'm sure we'll be talking about mining. I hope we'll also be talking about a lot more processing, because I do think this trend of localization will continue. It's not just driven by geopolitics. I think it's the other way. Geopolitics is sort of driven by what was already sort of started. So I think you'll see more localization. I think you will see technology and maybe AI and other forms of new ways of thinking disrupting how you do midstream processing. And so I think maybe we'll talk a lot more of that. I mean, we're already talking a lot about mining, so hopefully we'll talk about that part too.
So collectively, please.
Thank you very much, and I really appreciate all of your input. And so I actually lived in Ghana for a year. I'm current personal friends with the king and the president there, and so I really, this is more like a question and a comment. I think the localization is absolutely spot on, and they have no technology or knowledge, right? And for like the last 12 years, at least personally, I've heard the same comments on, the same old problems. I feel like the different supply chains also has different value. The single digit is at the mining profit, but then there's added value on top of it. And I feel like somebody, maybe it's Stanford or Charles, right? Like somebody needs to have a very clear picture of the globe. We're all one family here on the globe. We understand that through the AI. But what is missing is really a specific industry knowledge married with a very specific outcome desired for every tier of supply chain. So, and nobody can solve that if we all don't work together. And to our respected Secretary General, it's really, really important to have a local view and stay there to understand also, it's not just a technology investment, it's also resources, skill, upskill, because there's a mindset of how they work, and each country is a little different, and that matched up with the technology and investment. So until we solve the problem holistically, it's hard to actually make it equitable and profitable for the ideal picture we're painting here. Sorry, it's not really a question, I guess. Maybe a question.
The question was, who's going to lead all that? And I think it's a collective effort. You have capital providers on this side that are involved in each part of the supply chain that could bring it all together. And they look, even though they might be invested in one part of the supply chain vis-a-vis a single investment, they look across the supply chain and they see how things are connected together. We at KoBold also look at things from that perspective. And as you say, we are focused on, one of your comments is focused on local development, local talent development, and it's something that is a priority for us as well. I'm optimistic that with smart investors, many of whom are represented here on this panel, and companies all in this forum here, that all are like-minded in moving in the right direction in terms of what the sector can do in not only creating value for the minerals that we're producing or processing, but also contributing to the local economies and local development that we're all moving in the right direction. So I thank the panelists here today. Very much appreciate the lively discussion. And I think, Jeff, we're off for a break right now. Thank you all very much.
Thank you.